I want to ask you about your piece this morning, which is titled Policy Paralysis. Of all the topics you could have tackled, is this something about the shutdown or something we're hearing out of Davos or something else?
Well, it's sort of just thinking ahead to the next recession. I don't really think we're going to have one very soon, Carl, but I think one of the things I worry about is in the next recession is there could be some anxieties or spike in fears about the inability of the policy officials to help revive the economy. I mean, the Fed still looks pretty spent out. The funds rate, even though it's up to 2.5%, is still lower than at any other point in post-war history prior to a recession. It only gets there in a recession to this level we're at, and the balance sheet's still $3.5 trillion, and the efficacy of monetary policy has been decaying for some time now. And now we have a Treasury fiscal policy which is also looking spent out with one of the largest deficits without a recession that we've ever had. So I kind of think it's a chance that if we get into recession and the deficit blows out further, and rates go back to one handles in the funds rate, that we could have a lot of fear about an inability of our policy officials to help us, and that could create special risk for the next recession. I don't think they'll occur till then, but I'm a little worried about how the response might be in the next recession.
Jeff, one handles in the funds rate. I mean, how likely is that?
Who knows where the Fed might have to take rates again. You can imagine if we did encounter another recession, and I could see one unfolding in the next 6 to 18 months, it could come just ahead of that 2020 election. And if that's the case, you can imagine a lot of pressure on the Fed to lower rates. But I think the focus should more be on fiscal rather than monetary policy. Outside the U.S., there's a lot of room to cut taxes. In fact, Germany is making some proposals right now to do so. In the Netherlands as well, the U.K. is rolling forward tax cuts. China's cutting taxes. The Netherlands, lots of places. Fiscal policy could be more impactful than monetary policy this time in getting us out of what could be a downturn in the coming year.
Jeff, 6 to 18 months in terms of risk for recession. What do you think would cause it?
Well, there's a number of factors. I do think a tighter monetary policy around the world, we're seeing this, that's having an effect. But look at the indicators. One of the ones I like to watch is the gap between the unemployment rate and the inflation rate. As that continues to narrow, it signals an overheating economy. We're not there yet. When those two numbers become the same number, that's been a sign ahead of the last 3 recessions in the U.S., but ahead of many around the world. Again, we're not there yet, but I could see us getting there in the next 6 to 18 months.
Jim, we've spoken to you last year. You were very cautious. You said you wanted to see things like a dramatic spike in the VIX and the fear index to feel like you would get back into the market in a meaningful way. Could argue we got it in December. Where do you stand on stocks now?
I like them yet. I think that what we needed last year, I think the recovery was coming to an end, Morgan, in the sense that overheat was going to bring a recession. But we needed 2 things. We got them both, I think. One is we had a revaluation miracle last year. We took the trailing P multiple from 24 times almost in January a year ago to 16 times on December 24th. We're still at 18 times. So we radically revalued equities. But at the same time, what more importantly maybe is in order to elongate this recovery, we needed to slow the recovery dramatically. And I think we're doing that. I think we're going to slow 2% or less in 2019 in real GDP. We're going to be scared about recession for much of this year, but I think we're going to avoid it. And if you can grow at 2% or less, then you're going to put a pause button on the Fed. You're going to put a pause button on bond vigilantes. You're going to put a pause button on inflation pressure and allowing another rally here in stocks that could carry on for most of the year as the P multiple rises, even if earnings are kind of flattish for the year. So I think it's a good time on days like today to add a little risk to the portfolio, to tilt back towards economic sensitivity as people are dumping them today on fear of recession.
Yeah. Jeff, it's interesting. The Journal today looks at flows in money market funds as cash allocations continue to get pushed up. Do you think of cash as a percentage of overall holdings right now any differently than you did before December, let's say?
Cash does provide more of a yield now than it has in the past, and it'll certainly be there for you during the downtimes to offset volatility. But I think fixed income may be more attractive. Treasuries, intermediate duration treasuries, look, they're going to move against the ups and downs in the stock market, provide you a little bit of buffer there in terms of volatility. but also pay you a nicer yield than you're going to get on cash. Yes, the yield curve is flattened out a little bit, but you can still find a little bit more there out further on the yield curve. That looks more attractive to us than cash at the present time.
And finally, Jim, do you think it's consensus right now that we have to go back to those Christmas Eve, Christmas day after Christmas lows?
I think it's easing, Carl. I think that was a strong consensus. I still think a consensus is that we're going to have a period of significant sell-off again, some period where there's fear generated again. Whether we have to go all the way back down to the lows, I think people might be giving up on that a little bit. But I do think consensus is still that we might get like a 5% pullback and some fear yet before we rally even higher. I don't know if we have to, in part because of the strong consensus expecting to wait on a buy into the dip, if you will.